After a company has recorded its closing entries and made sure that the balance of all of its temporary accounts T's are equal to 0, the last step in the accounting cycle is to prepare a post-closing trial balance. Why do we need to prepare a post-closing trial balance? Why do we need to prepare any trial balance? The unadjusted trial balance assures that our debits equal our credits before the company adjusts its books. The adjusted trial balance assures that the debits equal credits after the company adjusts its books before we make our financial statements. And lastly, the post-closing trial balance assures that our debits equal our credits after all of our temporary accounts are closed for the period. The reason that we keep doing this process is if something goes wrong, if your debits don't equal your credits somewhere, frequently doing this process makes it easier to find the mistake. For example, if our adjusted trial balance had that good debit-credit equality, but our post-closing didn't, well, we know the mistake is during our closing process because we were good through the financials, so we must have made a mistake somewhere in post-closing. If we only made one trial balance at the very end, we wouldn't know where the mistakes were, and we would have to keep going back through all of our records for the month until we found it. So frequently making trial balances at these 3 different phases makes it easier to find the mistake in case you don't have debits equal credits. So when we prepare our post-closing trial balance, what happens to all of our temporary accounts? They are again our withdrawals, our revenues, and our expenses. Well, what happened to the T accounts for all of these accounts? As we can see right here, they're all equal to 0. And because they're all equal to 0, we don't have to put these on our post-closing trial balance. All of our temporary accounts are going to have a 0 balance, and we don't need to list them. Which means when we prepare our post-closing trial balance, the only thing that we're going to have is our asset accounts, our liability accounts, and our capital or equity account. While the assets and liabilities were untouched during the closing process. We did not touch a single asset or liability account in our 4 closing entries, which means the balance of those accounts has to be exactly the same as it was on our adjusted trial balance. So we can simply take all of those numbers straight off our adjusted trial balance and bring them over to our post-closing trial balance. As I've done here, I have all the assets and liabilities filled in. The only number that I don't have filled in thus far on our post-closing trial balance is our capital. Well, where's that going to come from? The capital is going to come from the post-closing balance of your owner's capital T account. And our Anderson Capital T account has a new balance of $38,330 after we've accounted for our income and our withdrawals, etc. in our closing entries. So we bring that number up into our post-closing trial balance. Then we check to make sure that our debits equal our credits, and when we add up the debits, we get $60,900, and when we add up our credits, we also get $60,900. As easy as that.